U.S. stocks are hovering near record highs. The Santa Claus rally is back in focus. And Wall Street is already looking ahead to 2026. But with valuations stretched, economic uncertainty still present, and key data releases coming this week, one big question remains. Can the market extend this rally, or is volatility just around the corner? Welcome back to U.S. Market View. Let's break down everything you need to know for the week ahead. U.S. stocks wrapped up last week slightly lower on Friday, but overall it was a strong holiday-shortened week. The S&P 500 gained roughly 2.3%, the Nasdaq Composite rose about 2.5%, and the Dow Jones added around 1.6%. All three major indexes remain very close to the record highs set on Christmas Eve. Last week also marked the second session of the so-called Santa Claus rally, which typically includes the final 5 trading days of December and the first 2 sessions of January. Despite the small dip on Friday, overall momentum remains positive as Wall Street heads toward year-end. Historically, this period has been important for markets. Over the past 75 years, the Santa Claus rally has never produced negative returns for more than 2 consecutive years. With both 2023 and 2024 finishing lower during this window, investors are hopeful this rally sends a positive signal heading into 2026, even though history is never a guarantee. The year 2025 has been a historic one for U.S. markets. After a sharp downturn earlier in the year following President Trump's spring tariff rollout, stocks staged a powerful comeback and pushed to multiple all-time highs. It wasn't just equities that performed well. Gold and silver surged to record levels as investors sought safety, while copper reached its own highs amid supply chain disruptions and tariff uncertainty. Now, with markets sitting near record levels once again, optimism around the Santa Claus rally has returned. This will be a relatively quiet holiday week, but there are still a few important economic reports investors should watch. On Monday, pending home sales and Dallas Fed, manufacturing data will provide insight into housing demand and regional manufacturing activity. Tuesday is the key day. The ADP Employment Report, Chicago PMI, and the minutes from the Federal Reserve's December meeting will be released. The Fed minutes are especially important, as investors will be looking for clues on how policymakers are thinking about inflation, economic growth, and the future path of interest rates. On Wednesday, initial and continuing jobless claims will help gauge the strength of the labor market, which remains one of the Federal Reserve's top concerns. Markets will be closed on Thursday for New Year's Day, and on Friday, investors will see the final reading of the S&P Global U.S. Manufacturing PMI. Even during a slower holiday week, surprises in labor data or Fed language can still move markets. As of Friday, traders were pricing in about an 80% chance that the Federal Reserve holds interest rates steady at its January meeting. This suggests Chair Jerome Powell is continuing with a wait-and-see approach. Inflation has cooled and GDP growth has improved. But the economy remains uneven. Many analysts describe the current environment as a K-shaped economy, where higher-income households continue to spend and build wealth, while lower-income households feel pressure from higher costs and slower wage growth. This imbalance adds another layer of uncertainty as markets look ahead to 2026. One of the biggest stories of 2025 has been the dominance of big tech, especially in artificial intelligence. NVIDIA became the first company ever to reach a $5 trillion market capitalization, highlighting the massive investment flowing into AI infrastructure. At the same time, concerns are growing around whether tech companies are overspending, whether valuations are becoming unsustainably high, and whether pressure could build in corporate debt and private credit markets. AI remains a powerful long-term growth theme, but at these elevated levels, investors are becoming far more selective. Beyond valuations, markets are also navigating geopolitical uncertainty, ongoing tensions in energy markets, global oil supply concerns, and the massive electricity demand required to support AI growth. Despite these risks, many major Wall Street firms remain optimistic. JP Morgan and HSBC see the S&P 500 reaching around 7,500 by the end of 2026, while Morgan Stanley and Deutsche Bank are even more bullish, targeting levels between 7,800 and 8,000. From Friday's close near 6,900, that would represent double-digit upside over the next year. Still, firms like State Street Global advisors continue to stress the importance of selectivity rather than blindly chasing the rally. So how should investors approach this week? With low holiday liquidity and fewer trading sessions, volatility can appear suddenly, even on light news. Long-term investors may want to stay patient and avoid emotional decisions, while short-term traders should be cautious around economic data releases and focus on quality rather than hype. The Santa Claus rally may continue, but risk management always matters. That's your US stock market weekly outlook. If you found this breakdown helpful, like the video, subscribe to US Market View, and let me know in the comments whether you're bullish or cautious heading into 2026. We'll see you in the next one.